Welcome everyone to Module 6. Last week we tackled how firms return capital to shareholders, dividends and buybacks. This week we flip the question, how do firms decide where that capital comes from in the first place? Capital structure, our mix of debt and equity, isn't just accounting trivia. It defines how risky we are, what returns investors demand, and how flexible management can be. I often joke that a CFO's favorite breakfast cereal is leverage loops. Get the balance wrong and your day starts badly. By the end of this module, you'll think like a CFO weighing tax savings, distress risk, investor expectations, and market timing. So let's start with why these financing choices matter so much for firm value. I do want to mention this module links directly back to Module 3 on cost of capital and forward to the valuation modeling in later modules. Some students find this particular week the most technical week, but don't get overwhelmed. The math simply operationalizes the logic that you already know. You'll move from textbook theory to quantitative analysis to executive recommendation. Now, before we start crunching numbers, I want to just have a quick recap on what capital structure really does for a company. Capital structure refers to the mix of debt and equity a company uses to finance its operations and growth. In simple terms, it's how a company pays for what it owns, whether it borrows money, aka debt, or raises funds from investors, aka equity. Here's what it does. First, it determines the company's financial flexibility. So a well-chosen capital structure gives a company the flexibility to fund new projects, expand operations, or weather downturns. Too much debt limits flexibility because loan payments must be made no matter what. Too much equity can dilute ownership and reduce control for existing shareholders. So for example, Apple uses some debt, even though it has a whole lot of cash, to keep financing flexible and avoid bringing back overseas profits that would be taxed heavily. Number 2, impacts risk and return. Debt increases financial risk because it must be repaid, but it can also boost returns to shareholders when it's used wisely. This is called leverage. A company with more debt can amplify profits, but also losses. And so the right balance can maximize shareholder value. A construction firm might borrow to take on more projects during a boom. If the projects succeed, profits soar. If not, the company still owes its lenders. The third thing it does is it influences cost of capital. Capital structure affects the weighted average cost of capital, WACC. You remember this from last week. The average rate of return a company pays for using both debt and equity. Debt is usually cheaper than equity because interest is tax deductible. I want to say that again. Debt is usually cheaper than equity because interest is tax deductible. But too much debt raises the firm's risk, which can make future borrowing more expensive. A retail chain might lower its WACC by substituting some expensive equity financing with lower cost debt, improving profitability. The fourth thing it does is shapes investor perception and valuation. Investors watch capital structure closely. A company with too much debt might seem risky, while one with too little might seem overly cautious or under-leveraged. The signal it sends can affect stock price and investor confidence. When Tesla started showing consistent profits, it reduced reliance on debt, signaling strength and stability, which boosted market confidence. And the last thing that it does is it affects control and ownership. Choosing debt versus equity determines who holds power in the company. Debt lets owners keep control, but adds repayment obligations. Equity brings in partners or shareholders who may want influence. Founder might take on a bank loan instead of selling shares to avoid losing control of the decision making. In short, capital structure is the strategic balance between risk, control, and growth. It's how a company designs its financial backbone to fund success and survive uncertainty. Alrighty, this slide is about one of the trickiest questions companies face after they've earned profits. What should we do with all this cash? It sounds like a good problem to have, but it's actually a strategic one because every option sends a different message to the market and affects the company's future flexibility. So let's break down the three main choices. Option 1, dividends. This is the classic route. Regular quarterly payments that say, we're stable, we're confident, and we'll keep generating cash. Investors love the reliability, especially retirees and institutions that want steady income. The catch? Once you start paying consistent dividends, it's really hard to stop without sending a bad signal. So it's a bit like a long-term commitment. Great if you can sustain it, painful if you can't. Option 2 is share repurchases. This is when a firm buys back its own stock from the market. It reduces the number of shares outstanding, which usually bumps up earnings per share. Repurchases are more flexible. You can do them when times are good and quietly pause when times are tough. They're also more tax efficient since shareholders don't pay tax until they sell their shares. That's why repurchases have become incredibly popular over the past decade. They give CFOs more control. Option 3 is retention. This means keeping the cash inside the company, building reserves, or reinvesting in projects that generate growth. It's the conservative choice, but it can be the smartest one when the firm sees good investment opportunities ahead. If the company's internal projects can earn a return above its cost of capital, reinvestment beats any payout. However, holding too much cash can frustrate investors. They start wondering, why aren't you putting this money to work? So that's the puzzle. Management has to balance three things: financial efficiency, how effectively cash is used; strategic flexibility, the ability to adapt to future needs; and market signaling, what your message choice sends to investors. And the truth is, there's no one-size-fits-all answer. It depends on where the company is in its life cycle, what investors expect, and what opportunities lie ahead. Apple's a perfect example. For years, it was famous for not paying a dividend. They just kept reinvesting and piling up cash. But by 2012, their cash balance was over $100 billion. With a B, yes, $100 billion. And investors started pressuring management to return some of it. So Apple began paying dividends and doing share buybacks. In fact, they've become one of the biggest share repurchasers in history, buying back over $600 billion worth of stock in the last decade. Why? Because Apple wanted to reward shareholders while keeping flexibility. Dividends create stability and show confidence, while buybacks give them room to adjust with market conditions. And importantly, they fund all of this without limiting their ability to innovate. They still have enough retained earnings to invest in new products like Vision Pro and AI development. That's the payout puzzle in real life, balancing investor expectations, flexibility, and strategic growth. All right, let's step back and look at the big picture. Why do firms even pay dividends or buy back shares in the first place? We've been talking about how they do it, but this slide reminds us why they choose to return cash to shareholders, or sometimes why they don't. We can think of this as an evolution from the clean, theoretical world of finance to the messy, real-world version that a CFO actually lives in. So let's start with the classic theories. First up is Modigliani and Miller, 1961, the dividend irrelevance theory. They argued that in a perfect world, no taxes, no transaction costs, no information gaps, it doesn't matter whether a company pays dividends or keeps the cash. Investors could just create their own dividends by selling a bit of their stock if they wanted cash. It was simple, elegant, and also completely unrealistic. In the modern world, capital markets are full of friction. There are taxes, fees, and information asymmetries everywhere. So now payout decisions absolutely do affect perception and behavior. And while they might not change the intrinsic value of the firm, they definitely move the stock price because perception drives sentiment, and sentiment drives valuation. So for managers, this becomes less about theory and more about messaging and psychology. Then we've got signaling theory. This one says dividends or repurchases are like a language managers use to communicate with investors. If a management raises dividends or announces a big buyback, it sends a signal. We're confident about future cash flows. But if they cut dividends, the signal is just as strong, only in the opposite direction. Investors hear something's wrong. And that's why companies will go to incredible lengths to avoid cutting dividends because it's seen as bad news even before the bad news is public. Finally, we have agency theory. This one's about control and discipline. When firms have too much cash lying around, managers sometimes get creative. They might start pursuing pet projects, overpaying for acquisitions, or empire building instead of returning money to shareholders. Paying out cash through dividends or buybacks actually forces discipline. It limits wasteful spending and makes management justify raising new capital when they want to invest. So the modern reality is this: payouts aren't just about rewarding shareholders, they're tools for communication, credibility, and control. And those choices carry real-world consequences for how investors value the firm and how management behaves. Let me give you a real-world example. General Electric, GE, around 2017-2018. GE had paid dividends for over a century. It was part of the company's identity. But as the company's cash flows weakened, they were forced to slash their dividend first by 50%, then again to just a penny per share. That decision alone wiped out billions in market value almost overnight. Why? Not because the dividend itself was huge, but because of the signal it sent. Management doesn't believe future cash flows are secure. That's signaling theory in action. Investors didn't just see a lower payout, they saw a warning about the company's future health. And sure enough, the years that followed were full of restructuring and asset sales. Contrast that with a company like Microsoft or Johnson & Johnson, steady dividend payers that rarely change their course. Their reliability communicates stability and confidence, and the market rewards that with higher valuations. So in theory, payouts shouldn't matter. In practice, they matter a lot because they shape how investors interpret a company's story. Payout policy is less about arithmetic and more about trust. Now let's look at what a CFO actually does, not just what the theories say they should do. This slide comes from one of the most famous studies on payout policy by Brov, Grom, and Harvey and Mike McKelly back in 2004. They surveyed over 380 CFOs to figure out how real-world payout decisions are made. And the findings? They revealed a huge shift away from the old-school dividend-centered mindset towards a much more flexible, repurchase-oriented approach. So let's unpack what that means. First, 94% of firms avoid cutting dividends at all costs. Once you start paying dividends, it's basically a lifelong commitment. CFOs treat a dividend cut like breaking a promise to investors. It destroys credibility and almost always triggers a big stock drop. So even when earnings dip temporarily, most companies still maintain dividends to protect their reputation. The study found that reputation and signaling effects matter more than the actual short-term financial hit. This tells us that payout policy isn't just finance, It's psychology and public relations rolled into one. Second, repurchases now dominate payout policy. Buybacks have become the preferred tool for returning cash because they're flexible, as I mentioned a couple of slides ago. You can do more when times are good and quietly scale back when times are tough. And the market doesn't punish you for it. CFOs love that flexibility. Buyback also allow for market timing. Companies can repurchase shares when they believe their stock is undervalued, which is a subtle way of signaling confidence without locking themselves into a permanent obligation. So in today's world, if dividends are like a long-term marriage, buybacks are more like dating, flexible, adaptable, and easier to pause if their circumstances change. Third, tax considerations have faded in importance. Historically, dividends were taxed more heavily than capital gains, which made buybacks more attractive. But tax rates have evened out over time, and that's no longer the main driver. Modern CFOs care far more about that flexibility, signaling, and earnings management than squeezing out an extra percentage point of tax savings. In other words, finance has evolved from being tax-driven to being perception-driven. Finally, buybacks now serve multiple strategic purposes. They're not just about giving money back, they're used as strategic tools. Companies use them to offset the dilution caused by stock-based compensation, to adjust leverage ratios, or to deploy excess cash when growth opportunities are limited. In other words, buybacks have become a multi-tool for capital management. So, if you had to summarize the CFO mindset today in one sentence, it would be this: dividends build trust, but buybacks give freedom. And that balance between investor expectations and financial flexibility is exactly what modern payout policy is about. Let's take another look at Apple, because they're the textbook case of this modern shift. Apple reinstated dividends in 2012, but what's really interesting is their massive buyback program. As I mentioned, they spent over $600 billion buying back their own shares, more than any other company in history. Why? Because those buybacks gave them control. If cash flow dips one quarter, they can pause. Nobody really makes a big deal or really even notices. If the stock price falls, they can buy more aggressively and send a quiet message to investors: we believe our stock is undervalued. And unlike a dividend cut, pausing a buyback doesn't make headlines or tank the stock. So Apple essentially uses dividends for signaling stability and buybacks for strategic flexibility. And that combination is now the playbook for most large, well-managed firms, everywhere from Microsoft to JP Morgan. I just said a whole lot on this slide, so let me give you a key takeaway here. Modern CFOs use payout policy as a strategic communication tool as much as a financial one. Dividends say we're dependable. Buybacks say we're confident and flexible. And the best firms know how to use both to tell the right story at the right time. This week, our case study is about AutoZone. So let's take a look at them. They practically have written the playbook on modern payout policy. AutoZone has taken a completely different path from the traditional dividend-paying model. They've built their shareholder return strategy almost entirely around stock repurchases, not dividends. And they've been doing it consistently for more than 2 decades. Let's break down the how and why this approach works. Number 1, 0 regular dividends. First off, AutoZone doesn't pay a regular dividend. None at all. That alone makes them unusual among large profitable companies. Most firms pay at least something to show stability. But AutoZone's philosophy is simple. We'd rather have a complete flexibility to decide when and how to return cash. By avoiding a recurring dividend, they don't lock themselves into quarterly commitments. Instead, they just adjust their payouts based on market conditions, which is gold for financial flexibility. It's also more tax efficient for investors since gains from buybacks aren't taxed until the stock is sold. So instead of signaling stability through dividends, AutoZone signals confidence through its actions and its consistency in repurchasing shares. Number 2, 20+ billion repurchase. Now here's where it gets impressive. Since the early 2000s, AutoZone has repurchased more than 20 billion of its own stock. Think about that for a second. For a company with a market cap that's typically around 50 to 60 billion, that's an enormous proportion of ownership they've bought back over time. By shrinking the number of shares outstanding, AutoZone has concentrated ownership, meaning each remaining share represents a larger piece of the company. This is one of the clearest examples of how a disciplined, long-term buyback program can dramatically change a firm's financial structure. 3, EPS engineering. Here's where the math gets fun. Even though AutoZone's net income hasn't grown dramatically every single year, its earnings per share, EPS, have skyrocketed. Why? Because when you reduce the number of shares outstanding, the same amount of earnings gets divided among fewer shares, and voila, EPS goes up. This is sometimes nicknamed EPS engineering, not in a shady way, but as a deliberate financial strategy. It's a mathematical way to increase per share value without necessarily growing total profits. And the market rewards it because higher EPS often translates to a higher stock price, especially when it's part of a consistent, credible program. And 4, leveraged strategy. AutoZone takes this even further by using leverage, borrowing money, to fund its buybacks. They maintain a relatively high debt-to-equity ratio compared to other retailers. Why? Because management believes the returns generated by reducing shares outweigh the cost of debt. This approach amplifies shareholders' returns, but it also increases financial risk. It's a bit like driving faster on the highway. You'll get to your destination sooner, but you better have good brakes and clear visibility. And to their credit, AutoZone has managed that balance well. Their steady cash flow from a reliable business model, selling car parts, gives them the predictability they need to handle that debt load responsibly. And 5 is the strategic objective. So what's the big picture here? AutoZone's goal is to maximize shareholder value while keeping total control over when and how they return capital. Their board can ramp up buybacks when business is strong or slow them down when conditions change without sending negative signals to the market. That flexibility is key. It's the polar opposite of a company tied to quarterly dividends, and it's worked remarkably well for them. This strategy has made AutoZone one of the best performing stocks in America over the last 25 years. Their share price has climbed from $60 in 2000 to over $2,500 today, largely driven by those consistent buybacks and disciplined capital management. It's an incredible case study in how payout policy, when executed strategically, can reshape a company's entire financial identity. Now, of course, this approach isn't for everyone. A company like Procter & Gamble or Coca-Cola couldn't stop paying dividends without chaos. Their investor base expects income. But for AutoZone, which has stable cash flows and long-term management discipline, the buyback first model fits perfectly. AutoZone's story proves that payout policy is strategy, not habit. Whether a firm pays dividends or repurchases shares should always align with its financial structure, risk tolerance, and long-term vision. Now that we've talked about payout strategies conceptually, let's get a little more quantitative. This slide gives us the core ratios every financial analyst or CFO watches when they're evaluating payout policy. These metrics tell us whether a company's payout approach is sustainable, balanced, and appropriate, or whether it's heading towards trouble. So let's go through these. Dividend payout ratio. This is the most classic one. Dividend payout ratio is dividends divided by net income. It tells us how much of the firm's earnings are being paid out as dividends. So if the ratio is 40 to 60%, that's usually healthy. The company's rewarding shareholders, but still retaining enough to reinvest. But if the ratio creeps above 100%, that's a red flag. It means the company is paying out more than it actually earns, either dipping into reserves or borrowing to fund the dividend, which isn't sustainable long term. Repurchase yield. Next we have repurchase yield, and that is share repurchases divided by market capitalization. This one measures how much value is being returned to shareholders through buybacks relative to the firm's total market value. It's basically the dividend yield equivalent for repurchases. For example, if a $100 billion company buys back $5 billion worth of stock, that's a 5% repurchase yield. It tells investors they're effectively getting a 5% return through reduced share count, even if no dividend is being paid. This is a big deal for companies like Apple or AutoZone, where repurchases are the main payout vehicle. Number 3 is where it all comes together, total payout ratio. This is dividends plus buybacks divided by net income. This ratio gives us the complete picture of how much a company's earnings are being returned to shareholders. Some firms look conservative if you only look at dividends, but once you add buybacks, they're actually returning 80%, 90%, or even 100% of earnings. So this is the true measure of a payout policy. It captures all the ways capital is being returned, not just the obvious ones. Next is one of my favorites because it's all about affordability. Free cash flow coverage. This is free cash flow divided by dividends plus buybacks. This tells us whether the company's actual cash generation can support the payout habits. If this ratio is below 1.0, the firm is paying out more than it's bringing in, and that's not sustainable. If it's comfortably above 1.0, that means payouts are well recovered. It's like a stress test for payout policy. Analysts love this metric because it cuts through the accounting noise and gets straight to the question, can they really afford this? And finally, the dividend growth rate, the percentage change in dividends per share year over year. This is one of the strongest confidence signals management can send. A steady, modest dividend increase, say 5% a year, tells investors our cash flows are predictable. We can expect stability and growth. If dividend growth is erratic or stagnant, that might hint at uncertainty or tighter cash flows. So, taken together, these ratios give us a 360-degree view: sustainability, flexibility, and consistency. Here's the key. You should never look at any of these one in isolation. A company might have a modest dividend payout ratio, but a massive repurchase program, which means their total payout ratio and their risk could be quite high. That's why analysts always combine them to see the full financial story. So let's go back to our AutoZone example for a second. They have a dividend payout ratio of 0 because they don't pay dividends. But their repurchase yield is extremely high, often 6 to 8% of their market cap per year. That means that their total payout ratio can actually exceed 100%. And their free cash flow coverage is typically solid, but it requires careful monitoring because they use debt to fund the buybacks. So while it's worked beautifully for them so far, it's not a strategy for the faint of heart. It only works when you have reliable cash flows and disciplined capital management. That's the balance we're talking about. Quantitative ratios that reveal how strategic choices play out financially. Numbers don't tell the whole story, but they reveal when the story stops making sense. These payout ratios help us see whether a company's capital return strategy is sustainable, flexible, or running on borrowed time. All right, now we're shifting gears from theory to practice. This is where you'll start to see the trade-offs we've been talking about come alive in the numbers. So in your Excel exercise, you're going to use that Excel model to test 3 different payout policy strategies: a dividend-focused policy, a repurchase-focused policy, and a balanced policy. Each one makes sense for a different kind of company and a different kind of investor base. So let's start with the classic approach, the dividend-focused policy. This is what you see with companies like Procter & Gamble, Coke, Johnson & Johnson. These are stable, mature firms with predictable cash flows, loyal investors, and a reputation built on consistency. They pay higher regular dividends, often targeting a payout ratio of 60 to 70%. That means the majority of their net income is paid out each year. Repurchases, if they happen at all, are small or opportunistic. The goal here isn't flexibility, it's stability. These companies attract income-seeking investors, think retirees, large institutional funds, who value steady, reliable checks over the capital gains. And of course, again, the unwritten rule for management is never cut the dividend. In the repurchase-focused policy, on the other end of the spectrum, we have this policy. This is where modern flexible model we saw with AutoZone or Apple. Instead of paying dividends, these firms return value through aggressive, ongoing share buybacks. Here, the dividend payout ratio is typically 0 to maybe 10%. Maybe a token dividend just to say in certain indices. The real action is in the repurchase program, large scale, market sensitive, and oftentimes strategically when management believes the stock is undervalued. This approach appeals to growth-oriented investors, people who prefer capital appreciation and tax efficiency over fixed income. It gives management freedom to adjust based on business performance or market conditions, but it also demands discipline. If you stop repurchasing or borrow too much to fund it, investors notice. And then we have the balanced policy, which tries to capture the best of both. This is the middle ground, a moderate, steady dividend, say 30 to 40% payout ratio, plus a consistent but measured buyback program. Microsoft, PepsiCo, they use this model. They maintain credibility with dividend investors while keeping flexibility through repurchases. The target audience here is diverse, a mix of income investors and growth investors. It's a pragmatic approach that fits companies in a stable but evolving industries. Firms that can avoid to share profits now while continuing to invest in the future. So here's what you'll do in the Excel file. You'll model all 3 strategies using the provided data, same company, 3 different payout policies. You'll calculate and compare key metrics: payout ratios, free cash flow coverage, EPS impact, and shareholder returns. And then you'll make a recommendation. Which policy is most appropriate given that company's situation? The key here is to connect the numbers to the strategy. A policy that looks great on paper might be unsustainable if cash flows are volatile, or one that's conservative might underperform in terms of shareholder value. If you look at Microsoft, they follow the balanced policy, steady dividend growth and consistent buybacks supported by a massive free cash flow. They're signaling stability and confidence. Compare that to Meta, aka Facebook. For years, they paid no dividend and focused entirely on reinvesting and repurchasing shares. Remember, that's the repurchase-focused model. Meanwhile, Coke represents the dividend-focused model. Decades of uninterrupted dividend increases that anchor investor trust. Each of these companies tell a different story through their payout decisions, and that's exactly what you're going to explore in this exercise. So think of this as your hands-on lab. You're going to move beyond theory and test how these payout choices affect financial flexibility, investor perception, and long-term payout. By the end, you'll see there's no right answer, just a series of trade-offs that every CEO has to manage. Now, this is where everything we discussed starts coming together. This is your Excel integration moment. The goal here is to take the three payout policy alternatives, dividend-focused, repurchase-focused, and balanced, and really put them to test using your Excel model. Why? Because finance isn't about finding the perfect answer, it's about seeing how your decisions behave under different conditions. This is where scenario analysis helps us move from theory to real-world judgment. So let's dig a little deeper into what you'll be doing in this exercise. First, you'll track dividend and total payout ratios over a 5-year horizon for each policy. This lets you see how stable or volatile payouts are as a company as their performance changes. For example, does the dividend-focused policy stay consistent, or does it start creeping above sustainable levels during a downturn? It's a visual way to understand long-term balance between earnings and distributions. Next up is FCF coverage analysis, free cash flow coverage. This is the CFO's reality check. Can the company actually afford these payouts? You'll identify the points where free cash flow no longer covers dividends and buybacks. If your ratio drops below 1.0, that means the company's paying out more than it's bringing in, and that's the warning sign. This analysis helps you see which policy remains resilient when cash flows tighten, say in a mild recession scenario. Then you'll calculate EPS accretion or dilution, basically the effect of share count changes on earnings per share. In a repurchase-heavy strategy, you'll often see EPS rise even if net income stays flat because the denominator, shares outstanding, is shrinking. That's the same EPS engineering effect we saw in AutoZone's case. It's a great way to see how repurchases shape investor perception, sometimes even more than raw earnings growth. Breakpoint identification. Now this is where your analysis gets strategic. You'll determine the breakpoints, the economic conditions under which each policy stops being financially sustainable. For example, at what growth rate does the dividend-focused policy start requiring debt to fund payouts? When do repurchases become excessive or risky related to earnings? Identify these thresholds, and that's exactly what a CFO does before making a real-world recommendation to the board. And finally, you'll run sensitivity testing. This is where you stress test your assumptions, your growth rates, margins, capital intensity, and see how fragile or flexible each payout approach is. Try pushing your model a bit. What happens if its growth slows by 2% or if margins tighten by 1.5%? Does one strategy hold up better than the other? By doing this, you're not just crunching numbers, you're training yourself to think like a strategist. In real corporate finance, assumptions are never perfect, so you test for resilience, not precision. So as you work through this in Excel, remember, the goal isn't to make the model perfect. It's to learn what the model reveals, how payout policies perform under pressure, and what trade-offs emerge when the conditions change. All right, now we're bringing y'all together the dividends versus repurchases debate. This is one of those classic finance questions where their answer is frustratingly, it depends. Both options create value for shareholders, but they do it in very different ways, and they send very different messages to the market. So let's walk through these trade-offs. When a company pays dividends, it's sending a message of confidence and stability, signaling to the market. Regular, predictable dividends say, We believe our cash flows are strong, dependable, and sustainable. Predictability versus flexibility. Dividends are sticky. Once you start paying them, you better keep paying them. Investors build those expectations, and dividend-paying firms quickly develop a loyal, income-oriented shareholder base. And that stability can be a strength, but it's also a constraint. Buybacks, by contrast, are flexible and discretionary. Who each approach attracts? Dividends tend to attract income investors, like I mentioned before, and buybacks appeal to more tax-efficient or growth-oriented investors, people in higher tax brackets, etc. So the investor base often shapes the payout policy. If your shareholders expect an income, a pure repurchase strategy could frustrate them. If they're growth investors, a large recurring dividend might actually signal that you've run out of new ideas. And here's the part that gets CFOs nervous. Dividend cuts are punished brutally. As I said earlier, it signals the something must be wrong with their earnings. There's also a key difference in how shareholders participate. Dividends are universal. Everyone gets the same payment per share, whether they want it or not. Buybacks, though, are self-selecting. Only the shareholders who choose to sell their stock participate, while long-term investors actually see their ownership percentage increase. That's a big advantage for investors who believe in the company and want a larger share of the pie. And finally, think about liquidity and commitment. Dividends require cash certainty. You need predictable earnings to keep that commitment going through good times and bad. So if it's a cyclical company like an automaker or an airline, they're pretty cautious with dividends because they can't promise stability in unpredictable industries. So when you line these up side by side, you start to see the pattern. Dividends are about commitment and consistency. Buybacks are about timing and flexibility. One isn't better than the other. They just fit different company profiles differently. Mature, stable firms lean toward dividends. Firms in dynamic or rapidly changing markets tend to favor buybacks. As we close out this discussion on payout policy, I want to shift gears from the technical side, ratios, models, and Excel, to something much deeper, the why behind financial decisions. Payout policy isn't just a math exercise, like I said in the very beginning. It's a reflection of what kind of company you want to be, what kind of leader you want to become, and how you define value creation. At the heart of all financial management is stewardship. Every decision about dividends or buybacks should ultimately serve long-term value creation, not short-term stock price optics. Executives have a fiduciary responsibility or duty to deploy capital where it will create the greatest risk-adjusted return for shareholders. And that sometimes means not returning cash if better opportunities exist inside the. All right, this was a long one, so let's wrap up everything we've covered in this module with a few big takeaways. We've talked theory, evidence, Excel modeling, and ethics. But at the end of the day, payout policy comes down to leadership judgment. So let's review the key lessons that you need to take with you from this lecture. 1. Dividends signal commitment. When a firm pays regular dividends, it's more than just cutting checks. It's communicating confidence. It tells investors our cash flows are steady, we can make this promise and keep it. That predictability builds trust, but it also creates obligation. Once you start paying dividends, it becomes very costly, reputationally and financially, to pull back. So dividends make sense when your business model is stable and mature, like utilities, consumer goods, or established industries. Think of them as the financial equivalent of saying, "You can count on us." Next, repurchases signal confidence, but a different kind. A buyback tells the market, "We believe our stock is undervalued and we're willing to invest in ourselves." It's a flexible, market-driven way to return capital without locking into long-term commitments. And here's the subtle but important point. Repurchases are discretionary. A CFO can increase or pause them as needed based on market conditions or cash flow performance without the market punishing the company. That's why buybacks have become so popular. They give management the ability to adapt in real time. The third takeaway might be the most important one in modern corporate finance. Flexibility trumps form. In other words, the specific method of returning cash, dividend, or buyback matters less than the ability to adjust when the world changes. Economic uncertainty, shifts in technology, market shocks, all of these demand agility. A great CFO isn't rigid, they're strategic. They know when to pivot, when to hold back, and when to deploy. That's why flexibility has become one of the defining traits of financially resilient companies. And finally, always test sustainability. Every payout policy looks smart in the good years. The real test is how it performs under pressure. Policy that seems conservative when profits are rising can become catastrophic in a downturn if it's not stress tested. That's why we model scenarios in Excel to see what happens when earnings fall, cash flows tightened, or debt costs rise. Resilience is built by planning ahead, not by reacting later. In other words, test your capital structure under bad weather, not just sunshine. Now, one last idea before we close. Context matters. A payout policy should always align with your firm's business model, growth stage, and stewardship principles. A mature utility company and a fast-growing tech startup shouldn't have the same payout strategy, and that's okay. What matters is that each policy fits the company's financial structure, the investor base, and long-term goals. And remember, payout policy isn't just a mechanical calculation, it is a message. It communicates management's vision, priorities, and even character. And when done well, it builds trust with shareholders. When done poorly, it signals uncertainty or short-termism. From a faith perspective, this comes back to stewardship. Using resources wisely, planning with discipline, and leading with integrity. Faith-informed finance isn't about avoiding risk, it's about balancing boldness with responsibility. It's knowing what's entrusted to us, time, capital, people, should be managed with both courage and care.